If you're a business owner, then answer this question. Would you sell your business today for $20 million, or would you keep it for 10 years and make $200 million? Answer this question now, and then answer it again at the end of this video. This question is what investor Kate McAndrews asked on a reel on her Instagram account. And the comment section was wild. Most people were very confident about their entrepreneurship, saying things like, oh, if I built it before, then I can do it again even better. I need to remind you that this is just a thought experiment. So the people commenting were not, in fact, owners of a company valuated at $20 million. Some of them, of course, said, no, I'll keep it. I think those are teachers' pets. What both parties failed to understand is this. And this is what only elite business owners know. You know, the ones that build legacy businesses. Proper business owners who weren't even present in Kate's comment section because they have no reason to be, they know that this is a stupid question. Not to throw shade on Kate. I love her work, and I think that she's doing a very good job at educating startup founders on their possibility to get investors and how to do so. But proper business owners know that the only way for a company to actually reach $200 million valuation from $20 million is actually selling a part of it today. Now let me introduce myself. My name is Serena. I am a business growth strategist, and I help business owners prepare for acquisition, whether they choose to sell off a minority stake in the company or prepare for full exit. If you want to learn more about that, there are some links below. If not, let's continue with the video. Now, I commented this, and Kate replied with, oh yes, the secondary. The secondary is only one out of 12 different scenarios to do it. Now, let me walk you through them. Because for business owners like you who are looking into ways of immediate capital injection or total exit from your company, I wrote a book with all scenarios, possible deal structures, including private debt, the entire blueprint with all phases, durations of phases, and deliverables for each phase in order for you to know what you're getting into prior to spending hundreds of thousands of dollars on M&A advisors who many times are acting like double agents for the PE company. Let's get into the types of deals. Kate mentioned the secondary sale. And a secondary sale is when a large angel investor or a VC buys 51 to 55%. It's one big investor that buys out you and some minority shareholders. It's used when you want to step back and the company is attractive, but it's not really PE level. As you see here, there's no institutional investor here. There's either a large angel investor or a VC. So the structure is the new investor purchases from existing shareholders, not from the company. The alternative from buying from the company means that the existing shareholders will be diluted and each share will have less value. In the case of a secondary sale, the structure is the founder retains a large minority and continues operating the business with strategic support, and capital goes into selling shareholders, not into the company itself, giving liquidity without a full exit. We have pros and cons for this type of deal. The pro is that it keeps the company somewhat independent, and it's a simple transaction, but the con is it has lower valuation than it would have been a strategic sale. The investor psychology behind it is that VCs will only buy a majority if they see a clear exit path in 3 to 7 years, because they're not really interested in your business. They're just looking for capital efficiency. An example of a secondary sale is when Ashton Kutcher invested in Airbnb in 2010 in Series B funding round. So the structure for that deal was a secondary sale. An A-grade bought existing shares from early employees and angel investors, The early employees were paid with sweat equity, as many startups do, and they were not newly issued shares. The founder shares remained largely intact, so this was primary liquidity for early stakeholders. The promises that the founders had to keep. The exact percentages of this aren't publicly disclosed, but around 51 to 55% of shares sold in that round were secondary. Founders retained a meaningful minority ownership, which means a meaningful stake of the profit margin. The rationale behind this was to provide liquidity to early employees and angel investors without diluting the founders, like I said. They brought in a strategic high-profile investor, which was Ashton Kutcher, who at the time made investing his whole personality and would go on late-night shows and talk about how he loves to invest in garage startups that only have 2 guys and a dog or something. That was the joke. And at the same time, the company itself, Airbnb, gained credibility and, of course, network effects. Like, oh, Ashton Kutcher put his money into this, then it means it must be valuable. This signals market confidence in Airbnb's growth and valuation. Now, before Ashton Kutcher bought in, we don't know who used to own Airbnb, who had stake in it, and if they lent money or they actually had physical stake in it. So it's undisclosed because the dilution level is uncertain because of previous funding rounds, which are private. And in 2010, Ashton Kutcher bought 55% and 45% for the founders. And then 10 years later, it took 10 years for this company to be legit enough to make an IPO, an initial public offering. So that's when they issued 56% of the stake of the company, and they retained 44%. So they only gave away 1%. And that is an example of a secondary. A secondary sale is just one of 3 scenarios that I have in the book for a partial exit of a company. This is the category of selling off between 50% and 90%. Lower than 50%, you retain the control and you're only doing it to get an influx of capital to fund your operations and scaling. And if it's 90% or more, you're exiting your company. But this is a partial exit. That's how we can call it. Another scenario for this that is not the secondary, as Kate said, is a strategic majority buyout. You as a business owner, again, keep minority equity because a strategic buyer comes along and acquires enough stake in your business to become majority shareholder and gain control. And you retain between 20 and 49% for future upside. It's used when you want liquidity, but you still want to benefit from scaling, because you keep a substantial stake in it. And the company itself has high strategic value, either because they have patents for tech or they have a huge customer base. The structure for a deal like this is that a buyer pays cash up front for majority stake, and you as a business owner sign a performance-based earnout for the next 12 to 36 months. Because if you walk away with that capital, you're gonna put a huge dent in the company. The cap table reorganizes, and as the board sees, it's you as a buyer, it's you, but you have a minority stake, and the buyer has a majority. The pros for this is that yes, it is a large liquidity event, and you can still benefit from an exit, a future exit, at a higher valuation because these people who are way better than you came along. But the cons for this are loss of operational control. This was also the case for the secondary sale of Airbnb. They didn't have operational control anymore. This was granted because they had minority, they had 44%. It had been granted to angel investors or VCs. So the investor psychology behind the strategic majority buyout is that they seek synergy and control, but would like founders to remain on board for continuity. An example for this is when Google bought YouTube in 2006. The structure for this deal was a strategic majority buyout. Google purchased a majority stake in YouTube to gain control while retaining key founders. The acquisition combined stock as well. For percentages, Google acquired 65 to 70%, we don't really know, and the founders retained a minority stake and continued to manage operations. The rationale behind this was that the strategic acquirer, in this case Google, sees high growth potential and wants control without a full buyout. They secure a leading video platform, which is YouTube at the time in 2006. It was already pretty big. Think, what was that guy's name? Something William Johnson. I will look him up. Ray William Johnson. This is the time of Ray William Johnson when Google bought YouTube, and of Filthy Frank and early PewDiePie. Wow, what a time to be alive. What a time to be on YouTube. It was way less censored. Oh my God, the stuff that I've seen before 2006 on YouTube, my God. Remember? Anyway, sorry. The whole idea was to also integrate with Google Ads and expand the online presence while keeping the founding team operationally involved. The retaining of the founders mitigates execution risks and preserves the company culture, because they already built something really amazing and they didn't want to eliminate them because there was nothing like YouTube. There was Vimeo and the Daily Motion and whatever, but YouTube was the best, obviously. So before, let me walk you through the deal. This, again, remember, is a strategic majority buyout. So before this event in 2006, YouTube was 100% private ownership. In 2006, Google came along and said, you know what, this business, your YouTube, is worth 2.4 billion, maybe 2.5. And they both agreed. And so Google bought two-thirds of YouTube, and the private founders remained with 1/3. This is a beautiful story. I like it. Now let's go through a different scenario. The private equity recap. So a PE firm this time buys between 60 and 70%, so 2/3. A PE fund buys a majority and injects money for growth. And you as a business owner take cash off the table. It's used when businesses are solid, but they need capital for scaling. So getting into new markets, for acquisitions for other companies, for systems, Because the thing is, the business that is the vehicle that got you to this point will not get you to the next point. And this is the fundamental purpose of equity, of value creation. You need to pour cash in the fuel mix of the engine for it to go fast and achieve escape velocity. Anyway, you might also get an incentivized management plan, because yes, you no longer have majority stake into the business, but they kind of need to keep the business on the same steady course that it was in. In this case, the PE wants predictable cash flow and scalable operations. Of course, not all businesses qualify for this type of private equity recap, because this is an institutional investor. It's not Ashton Kutcher or two guys in a garage. There's gonna be a lot of due diligence here. So these are the three scenarios for value creation, but these are only from the category that Kate mentioned. And the truth is, you can sell less equity to make your $20 million business go to $200 million in 10 years. This is a pretty high percentage, because we discussed partial exit more than 50%, you lose control. But you could also keep control and just sell off some equity for raising capital, which is up to 25%. You could also apply for private debt, and in that case, private debt has 4 different scenarios: early stage, growth stage, mature, and late mezzanine. And there are different interest rates for each one of these phases and different expectations from the lender. And of course, you can have the total exit when it is worth $200 million. You can earn $180 million or more. But in order for your company to reach that point, you need to start selling today, because you need the cash, the management, and the marketing behind this type of value creation event. If you want to learn about all these scenarios and not just the secondary. I invite you to check out my links. If it's 2026, the book is out now and you can buy it. It's cheap and it's going to give you an idea of how to properly manage your business like a legacy business, like a Fortune 500 business, and yes, be able to then sell it for 200 million. Thank you for watching. Bye.